Alrighty, folks, this is a surprise live stream. I don't normally go live with my guests. We typically record and post later, but I thought, why not go live with Jason Hartman? He is amazing. And we're going to start off this discussion by talking about a $63 million real estate Ponzi scheme. Again, folks, one of the things that's going to happen when the tide goes out is all the fraudsters are going to be exposed, and some of them are going to go to jail. What do we got, Jason? Something just happened recently.
Well, several months ago, everybody began asking me about Marco Santarelli, Narada Real Estate, Narada Capital Management, I think was the name of one of his other companies. You know, I always thought the guy was a bad apple. He did a lot of sleazy things to me over the years and other people I know. But regardless, he was indicted in federal court in Orange County, California. He was accused of running a $62.5 million Ponzi scheme. So this is Marco Santarelli, Narada Real Estate, Narada Capital Management. And this is from the Orange County Register showing he was charged with bilking investors out of $62.5 million. Some other posts I've read about it say it was a $90 million Ponzi scheme. But regardless of the amount, it's enough. Okay.
Yeah, it's a big number. Yeah.
Yeah. And he had a hearing 1 week ago today. And from what I can tell, Michael, he pled guilty and took a plea deal, but his sentencing won't be until next March. And I guess it could be as much as 20 years in prison, is my understanding. I think the government did seize some money from him. Someone said it was like $5 million. But again, that could never repay all the investors. If people got jilted out of $62.5 million or $90 million, the investors are still losing a lot of money there for sure. And who knows if they'll recover more or not. But, you know, this just goes back to the thing that you and I do, right? And that I have talked about for 21 years. It's part of my original framework, which is the 10 commandments for successful investing. And the one that has resonated most with people is commandment number 3, thou shalt maintain control, okay? In other words, be a direct investor. Stop relinquishing your financial future to somebody else, whether it be some person on Wall Street, some financial advisor, a syndicator, a fund manager. I mean, look, a lot of these fund managers and syndicators are crooks to one degree or another, and they just haven't been discovered yet. I mean, think of it. Bernie Madoff ran his scam for, I don't know, like 30 years. So, you know, people could literally go decades and not know this person is a scammer. You ever watch the show, Michael, or maybe anybody watching or listening, ever watch the show American Greed on CNBC?
Oh, yeah, of course.
It's a great show, huh? Yeah. About all these crooks. And what's interesting about American Greed is that literally 99.9% of those episodes is about someone who raised money from investors and had a fund or was syndicating deals and ripped them off. And the thing that you always notice about them, there seems to be some real common threads. They were always very generous. Okay. And my theory about that is, you know, when you don't like actually earn the money, when you steal the money, you know, it's easy to be generous, right? Because you didn't earn it, right? Yeah. It's just money it's ill-gotten money. They always say they were always really generous. They always donated to charity. And I think that's usually a cover for this type of stuff, right? And there are multiple levels of scams and ripoffs. In commandment number 3, I say, thou shalt maintain control. First problem, if you relinquish this control, you might be investing with a crook. Okay, yep. So whether it be Marco Santarelli and Narada Real Estate or Narada Capital or whatever his company's called, you know, Bernie Madoff, Enron, WorldCom, Global Crossing, you know, there's a zillion of these stories, right? As all of the CNBC episodes on American Greed. So you might be investing with a crook. But the second problem is you might be investing with an idiot. Yeah. And just their stupidity and incompetence will cause you to lose money and suffer.
Yeah, okay. You know, I'm glad you brought that up because I think there's a lot of pain coming, especially in the syndication space, value add, short-term debt.
And there already has been a lot of pain. I mean, there's a lot of litigation. You and I both know that in these.
Yeah, we've seen nothing
these
yet.
Apartment investors, yeah.
Yeah, the multifamily value add, you know, Class C to Class B story sold so well, and it's going to be really interesting to see who was a crook and who was stupid.
Yeah.
Right. Because there's no crime against being stupid.
Yeah,
Right.
unfortunately, you're right.
Yeah. And again, I think a lot of LPs, limited partners, have already lost their money. They just don't know it yet. And it's gonna crush a lot of people, unfortunately.
Yeah, no question. And hey, if you're watching or listening and you have questions, just come on, comment below.
Yeah.
And Michael can even bring you on the air if you have a complicated question, and we can
There you go.
we can all talk it through. But so commandment number 3, you might be investing with a crook, you might be investing with an idiot, you'll lose money because of their crookery or their incompetence. But the third problem, and this is the most common and the easiest, and it's not even illegal. Okay. The third problem is they take a huge management fee off the top for managing the deal. Okay. Yeah. The typical deal is that these sponsors will find a property to buy, right? Like a multifamily property, very common. And they'll set up the deal. They'll start raising money for it. And right off the top, they get between 25, 35, maybe I saw one that did mobile home parks, 50% sponsor fee. Like literally before you as an investor, as a limited partner investor, have any chance of making money, that sponsor is getting 25%, 35, 40%, 50% maybe, right? Just for finding the deal, not for putting any money in the deal. You're the one at risk. It's your money. All they did is find the deal, right? But then it gets worse because they engage in what I'm going to loosely call money laundering. Okay. I don't mean money laundering like in a legal sense where, they're a drug smuggler and they're laundering money to clean it. What they're doing, Michael, is they're basically laundering money to other entities that they own and control. They're doing what crooked politicians do. They're influence peddling. Okay. So here's a couple examples of that. Say there's a guy who does multifamily apartment syndications. Okay. And he's hiring a lot of construction people. On the side, for his own account, he's doing fix and flips, or he's fixing up his own house, maybe adding on to his own house, right? And so what this guy will do is he'll say, look, I'll give you this job to remodel these apartments if you'll remodel my house. And that doesn't even show up on the books, right? So that's influence peddling, kind of a form of the money laundering I was talking about. But the other thing is they'll have other entities. They'll have management companies, and they'll deputize their own management company to manage the project, right? And then they have their own construction company that does the construction on the project, right? And they're just overpaying for all of this stuff with your money, okay? Yeah. Be a direct investor. How long does it take people to learn this stuff? Yes, it's a little more responsibility. You're going to have to be a little more involved. But I would argue that with the scams that these people pull, whether they be the legal scam of just charging a huge management fee and laundering the money to their other entities, right, which all of them pretty much do, or totally crooked things, right, you have to hold them accountable. And you have to constantly try to audit the deal and audit the books. Yeah. And most investors, they're just not paying attention. I'll give you an example. I invested in a deal with a multifamily syndicator. I know this stuff because the School of Hard Knocks, I've done it. Okay. And I just looked at that deal. And by the way, most of these deals, you can't do a 1031 exchange either. Okay. So that's another big tax bite versus being a direct investor. But I did this deal and I was just looking and evaluating the returns I got over the last few years. And they suck. Yeah, I could just put my money in the stock market or treasury bills. I mean, like, it's not much better than treasury bills with like no risk, right? So be a direct investor.
And again, this is why we talk one rental at a time. I think there's a lot of investors out there that think they're too busy. They think it's too hard. They think it's, they just convince themselves that they're just too busy. And, maybe they've had good fortune in life and they got some money from stock or tech or whatever it is. And they're like, I'm just going to put it to work because I'm too busy. Yeah. And that's just so dangerous.
It is.
Right. It doesn't take very long to have a buy box, look at it every day, figure out average, buy a great deal. Right. I'm not telling you to buy a 100-unit building. We're telling you to buy one 4-bedroom house, one duplex.
Look, how many people do you know that got rich buying a few houses? Right. Like lots of people got rich with that program. Okay. Absolutely. We all know people. Hopefully we're one of them, right? Like Michael and I. Okay. But nobody gets rich investing in a syndication or a fund. Like name someone who got rich going to some syndicator And who gets rich? The guy who set up the deal.
Yeah.
Okay. The general partner is the one who gets rich.
Absolutely.
The limited partners are the ones who get the scraps, the leftovers. Okay.
Yeah.
There are some, let me tell you folks, there are some very well-known and probably respected people that I know, okay, and Michael probably knows too, that I'm telling you, they are ripping you off. Okay.
Yeah. One of the things I heard from somebody I trust is, he's like, Michael, it really comes down to this. The bigger the name, the worse the return.
That's a great saying. So, there's that flashy guy flying around on his jet. There's another well-known guy who's written a bunch of books flying around on his jet. And, how much of the jet are they billing to the syndication that if they have to travel?
It ain't zero. It ain't
zero. If they have to travel there, right? Yeah. And they wine and dine investors. Oh, here's the other scam. This is unbelievable, right? They will spend money marketing to get new investors with the previous investors' money.
Of course.
What a scam. Like, that should come out of their business. But they can argue that, hey, this is going to make the investment better if we get more investors in. It sounds like a Ponzi almost, right?
Yeah.
It's not a Ponzi technically, but
no.
What they'll do is they'll run a bunch of ads on Facebook or wherever about the deals they have and this kind of stuff. And what they always promote is the deal.
Right.
That means the property, right? They say, oh, this is in a growth area. It's a 200-unit apartment complex, Class A growth area. They'll do webinars and all this kind of stuff. But what they never tell you is about the deal between you and them. That's the most important deal. Not the property, right?
Yeah.
Of course, I hope they picked a property that's going to make money. I mean, duh, that's, the most obvious thing, right? But they're always talking about the property. None of their ads or none of their materials talk about the deal, how much they're skimming off the top, right?
Yeah. Yeah. Well, the next thing I want to talk about, because I know we've only got about another 30 minutes with you. And again, folks, if you're watching this and you have questions, you want to ask Jason or myself or both, put them in the comments. We'll get to them. But Jason, I'm hearing more and more doomers, and yes, unfortunately, we got to talk about the Crash Bros and Crash Sisters, telling me that we are on the cusp of making 2008 look like a birthday party. I mean, what do you say when people say that this is going to be that much worse than 2008, what we've just entered? How do you even respond to nonsense like that?
It's just stupid. Like, it's just so dumb. But then they've got their deal, which will make you all this money, their syndication, right?
Yeah.
That's unbelievable. We've talked about this extensively. Okay. And, you and I both agree, look, right now, there is a housing shortage. I mean, look, all real estate is local. We all know that. There is no such thing as a national real estate market. But for efficiency, we're just going to talk about the national market, right? I mean, there is a housing shortage in the United States. Rates are on the downswing. So housing is actually getting cheaper, not more expensive. The price might be going up, but the price is not going up as fast as the rates have been dropping.
Correct.
Okay. So the rate is more important than the price. I was just watching the news this morning about how Trump is going to name Jerome Powell's successor before the end of the year. And he's going to put an easy money guy in there. And, you saw that chart that I've shared a lot on Instagram. And if you want to talk about that, I can try and pull it up too.
It's really interesting to me because, again, when you think about housing today, it's always and has been an affordability issue. Lots of the doomers love to quote Reventure Consulting that has income divided by home price or home price divided by income, whatever. And that's just not how it works. We don't pay cash for housing.
Yeah.
Right? It's price, it's wages, and it's interest rates. And they always conveniently skip that. And the fact that you can take 1981 and it looks cheap and then take 2025 and it looks crazy, it should tell you all you need to know. 1981 is still the worst year ever for housing affordability. And it's so funny that people miss that.
Here's an example. I mean, look at this. This is March 5th, 2009. Now, Michael, you were in the business back then. I was in the business for a long time by then. Okay. Everybody was in so much fear. I mean, this was a very scary time. Try, folks, everybody watching, everybody listening, try and remember what you were thinking about and what was in every article you read, every time you turned on the TV, every time you watched a video on YouTube. Every news story was about how the world is coming to an end.
Yeah.
Okay. But we sold this property This was an REO property in Franklin, Indiana. It was built in 2006. So at the time of this proforma, it was only 3 years old, right?
Mhm.
This is 3,400 square feet for $83,000,
Oh my
$24 a square foot, Michael. $24 a square foot. And the rent way back then was $11.95. That was the projected rent. Okay.
Wow.
Look at the return you would have had back then, but it got much better than this. This is a snapshot in time. It was a 40% annualized return, assuming you pay $83,000, which is the price of the house, and assuming you get $11.95 a month, and assuming you keep all these expenses where they're projected. That's a 40% return on investment. That is life-changing.
Yeah.
And guess what? This property only got better because we know what happened post-2009. I mean, if you owned this property for 5 years, you made a fortune. If you owned it for 15 years, you made a monumental fortune.
Yeah. Yeah. It still bothers me that people say, right? It's like they're giving false hope.
Yeah.
Right. You're in 2025. You're a married couple. You're renting. You want to own a home, and you have these doomers who are saying 2008 is going to be a birthday party, which again translate to, housing falling 50%, 60%.
Yeah. Right.
And these folks who believe these charlatans and fraudsters are just going to sit back and wait. And, what happens? Well, again, I'm not calling for any crazy housing boom, but it's not going down 60%.
No,
it's just, it's mind boggling to me.
It's ridiculous. I mean, that stuff's ridiculous.
What do you tell someone? Let's just say they're owner occupants, right? They're not investors. They're not looking to add anything to their portfolio. They just want to buy a home.
Yeah.
But it's expensive. Yeah. It's tough out there. Do you tell them to wait? What's your advice, Jason? What are you telling, if your niece or nephew came to you and said, "Hey, I'm looking to buy, what should I do?"
Yeah. Look, I mean, all you have to do is look at the inventory versus the demand. That's it. That's the whole equation. Yes, the cost of money matters, but the cost of money, the interest rates, that equalizes itself eventually, okay? Because it'll either equalize itself by rates coming down and retrenching or prices coming down and retrenching. But at the end of the day, it's very hard to create new housing, okay? And it's very inelastic. It's very hard to build homes, okay? It's very expensive to build homes. So to create additional supply is a huge, huge problem. And unless that problem is somehow solved, it's just kind of like a no-brainer, okay?
Yeah.
You don't have to worry about it. Let me show you another chart that's interesting, Michael.
Well, we bring that up. We have our first question for you. So let's look at the question first, and I'll look at the chart in a second. Here's the question. Jason, have any thoughts or ambitions within Gary, Indiana?
You know what? We have dabbled a little bit in that market. That was always kind of like a blighted market, right? Yeah. That's how it was known. And I'll tell you a funny story. I remember I was with a bunch of friends who went to Notre Dame. We were speeding to the Notre Dame game years ago from Chicago to the stadium at Notre Dame. And my friend Heather, who was driving, got pulled over. And we were not too far from Gary, Indiana. And the highway patrolman said, "If you'll sing the Notre Dame fight song, I'll let you go." So she got on the PA. There's a whole bunch of us in the car. She got on the police car's PA system and started singing the song.
Nice. Good for
so
her.
We let her off without a ticket. Yeah. So Gary, Indiana, look, I mean, this is one of those really inexpensive markets that is getting better. There's just no place to go. A lot of years ago, I started talking way back in 2004 or so about what I call the water theory of money, for lack of a better name. Okay. And the water theory is this, if I take this bottle of water here and I pour it out, what is the water going to do? It's going to go to the lowest point.
Correct.
Money does the same thing. It always looks for the cheapest thing, wherever you can buy the most for the money you have. And so that's why some of these areas that were formerly blighted are becoming like an opportunity, But I wouldn't say that's a prime one. Like that wouldn't be at the top of my list, okay?
Yeah.
But, it is interesting. All right.
Very cool.
So this is existing home sales, and it goes back to 2016, all right? So back in 2016, you see that sales were just above 5 million. They kind of bounced around in this area. And then COVID hit and everything shut down. Okay. And then the COVID quantitative easing and lowering of rates and money
printing. Yep.
Yeah. It shot up. Okay. And sales just went through the roof because housing became so affordable. Okay. So here in this spot, Okay. This is where we've been since rates went up over the last 3 years. Okay. Only at about 4 million homes selling per year.
Yeah.
So what we've got here is we've got a whole bunch of pent up demand of would-be home buyers that have just been putting it off for 3 years.
Yeah.
And so what is that deficit, Michael, right? Well, it's either about 1.5 million, right? Between 5.5 million and 4 million, okay?
Sure.
Or it's up to like almost 7 million. All right. So whatever that deficit is, I would estimate it's about 5 or 6 million buyers who've been just putting it off.
Sure.
These people are going to come into the market as the rates decline. And
yeah, I'd love to get your thoughts on it, because this is something I'm saying about rates. I believe we're on the cusp of a trifecta.
Yeah.
Right now, I believe there are lots of people doing what I'll call rate and term refis. These are the people that did the 2-1 buy downs against my better wishes. I think a lot of people did them, right? Marry the house, date the rate nonsense from 2 years ago. I thought it was a bad idea, but it looks like they got lucky. And again, refis are up 80% from last year. So I think we are currently experiencing a mini refi boom, which is probably mainly rate and term. So that's one.
Mortgage
That's
brokers
happening.
are happy.
Yeah, they're no longer starving. They got some crumbs. Step 2, this one is important for guys like you and I. And I'm looking at my portfolio right now. And that is, at what rate do I go do a monster cash out refi?
Right.
I'm not doing a cash out refi at 8 or 7 or 6. But I'm telling you, I might go grab 7 figures, maybe multiple 7 figures at 5.5.
Yeah.
5.25. Right? There's some magic number where we go and tap that equity. Last time I saw it, we have 37, almost $38 trillion in home equity.
Yeah.
If Americans do what Americans do, which is spend, we're going to go get $1 trillion of home equity in the next 12 to 18 months, I think, if rates go to 5.5. Then the third leg of the trifecta is, when do we ignite move up buyers? And the move up buyer is really what caused that deficit, because they're 2 transactions. They're a sell and a buy.
Yeah. Right.
And that's how you go to 4 million from 6. So, I think there's every sign that rates are going to continue to drift lower. We have a Fed meeting this week with a 1/4 point cut, likely another quarter in December. Guaranteed a new Fed president in May. I don't know, Jason. Rates might be 5.5 by the summer. I don't know.
Oh, and 5.5 is the magic number. I mean, so many people will be able to afford a new home. And I got to find that chart for you, Michael, but it's like over 7 million people could qualify for the median price home if rates hit 5.5%. So it's incredible. It really is incredible. I mean, we only have just about 830,000 homes for sale in the US right now, somewhere around there. And say 1.5 million new people enter the market, which I would argue is kind of a low estimate. Okay. It's probably going to be higher than that.
Mm-hmm.
I mean, what's going to happen? Bidding wars, prices are going to go up. It's going to be crazy again. Maybe not the craziness of the COVID era, of course.
Yeah.
Yeah.
We don't need that again, please.
Because we had constrained, that was much worse, because we had constrained supply chains. We had paranoia. We had fear, but we did have cheap money. Okay. Mm-hmm. And that's what drove the prices way up. Folks, you got to realize that once in every 10 years, there's definitely, if you look at history, a big real estate boom. Okay. And once in every 10 years, there's also a solid time over the course of several of those 10 years that you're making money in real estate. Okay. Just look at the history of it. It's pretty easy to just figure that out. Mm-hmm. And right now, we're just at this time where the market is very muted. It's very boring.
Of course. Well, it should be.
That way for years.
Yeah. Again, one of the things that I've always found interesting is I've looked at real estate every decade back to the 1970s. And to your point, real estate over a decade typically does really well. But what we saw in the 2020s is in my opinion, we got all the appreciation for the decade in 2 years.
Yeah.
So that just means we're going to be muted for the next several years, right? We've already done 3 years sideways. We're probably going to do 3 more years. But again, people hear me say that.
3 more years sideways, Michael. I mean, all you got to do is have, a million, 5 of those buyers who can now qualify come into the market.
Yeah. Well, I'll stand by my call, but we'll see. Again, it's certainly not going to crash.
Yeah.
You can't unlock 1.5 million buyers and have the market fall 40% like the crash idiots are calling for.
Well, and you're really unlocking over 7 million buyers. Okay.
Right.
But that doesn't mean they'll all actually buy, right?
Correct.
Some of them will just rent.
Yeah. And one of the reasons I say that the real estate will be sideways is more about mathematically how median is calculated. One of the reasons I think you're going to see transactions go up at 5.5 is we're going to unlock the low end. And the low end is not transacting at great quantities today. So, some of this is just statistical math on how the median is calculated, why it'll appear flat.
That's a very good point, because remember, when we're talking about real estate deals and our interest in investing, we're talking about the entry-level market. We're
Correct.
not talking about expensive homes. We're not talking about, homes that are just in the median. We're talking about cheap houses that are necessity type housing, entry-level housing.
Yeah. I do have a question for you. I've never asked you about it. It is rumored, and I think it's probably pretty likely, that Fannie and Freddie will become public entities again instead of government backed. Any thoughts on what that process might mean for rates? Do rates go down? Do rates go up? Do you have any thoughts on Fannie and Freddie going public? What it might mean for us home buyers?
I have thought about that extensively since about 2010. And I don't know. But if I had to guess, I would estimate that it'll keep interest rates higher than they would otherwise be with the government subsidy.
I couldn't agree more. I think that's in my world, the government guarantee means less risk.
Right.
And by removing that means more risk. So, all things being equal, rates will be higher than they would have been without the guarantee. That's kind of how my brain ties that together as well.
Right. And I agree with you. So what does that mean? What that means is a buying market that isn't as radical, where prices aren't going through the roof, where it's not as crazy as it has been many times throughout history. Okay. And many times throughout the time I've been in the business, not just COVID, but way before that, back in the 90s. Okay. What that means is more upward pressure on rents. Because remember, people only have 3 real choices. They can buy, they can rent, they can be homeless. Okay. Mm-hmm. And those are the options. Yep. And if they can't afford to buy, they're going to rent. And that's going to put upward pressure on rents. If they can afford to buy and they want to buy, they're going to buy, and that's going to put upward pressure on prices. The great thing about income property is that you can make money in any market. You just have to adjust your thinking and your strategy, right?
Mm-hmm. Yeah. The other thing I wanted to ask you about, and I think we may have talked privately, but not here in a live forum, was we've obviously heard President Trump and many in his administration, Scott Bessent, J.D. Vance, and others included, that they're thinking about or on the cusp of declaring a housing emergency.
Yeah, we have talked about that a little bit.
Yeah. So the housing emergency, without any color, we're left to guess. Any thoughts on what that might mean?
Yeah, I don't know. I don't think any of us really know, except the insiders. The only thing I could really think of that the government usually does is they subsidize the buyers, which is the exact wrong thing to do.
It's demand, yeah.
It's kind of like the Cash for Clunkers program under Obama. We all remember that. It was a disaster, okay? He said, hey, we'll give you money if you'll get rid of your clunker and put it in the junkyard. We'll give you money to help you buy a new car. So what happened? Yeah. Shortages, right? Because all they did is increase demand for new cars and prices went up. And that's likely what the housing emergency will be, is some sort of subsidy. The only subsidy that really works is subsidizing construction on a massive scale. And so, Trump, before he was reelected for the third time, not the second, the third, if you get my point. Before he was reelected for the third time, he was talking about letting home builders build on federal lands.
Yeah.
Okay. Now that doesn't really change the equation hardly at all for entry-level housing. Why not? Well, because the land is such a small part of the equation that drives the price on an entry-level home. Mm-hmm. On a high-end home, in a high-end market where there's tons of demand, the land value is most of the value. Correct. On a low-end house, the land is only maybe 20% of the value. Mm-hmm. And he can't give it to the developers because people will just be livid if he did that, right? It wouldn't be fair. He's picking winners and losers, right? That would be like considered socialism. So he's going to have to sell it to them. The federal lands aren't really in super desirable places, most of them. So that doesn't
Yeah.
move the needle, if you ask me.
Yeah, I mean, the biggest challenge when I look at this, the single family home market, it's all controlled at the local level. It has almost zero federal oversight. It's the local rules and laws. And so when I kind of play that game, the only thing the federal government could do is create incentives, right? They say, hey, we want to do A, B, and C, and any cities or locales that adopt A, B, and C will give you some money for whatever.
Well, right. The thing we really should be talking about in this equation is eliminating property tax.
Oh, yeah, we've got Florida and other 8 states talking about
Tennessee, Texas. I mean, Michael, I honestly don't know how they would pull this off. But if it happened, I think that would instantly push prices up by 10 or 15%, instantaneously.
Because let's play this out. Yeah, so let's play this out. So again, housing is and has always been an affordability issue. Yeah. That's the price, the payment, taxes, and insurance. So if you take out one of those three, magically you have more buying power. So you're absolutely right. It would push prices higher. Here's the deal. The first state that dumps property taxes wins. Massive win.
Absolutely. Yeah, absolutely.
Yeah, the first one. But here's my question for you, right? As an old accountant, I'm like, okay, you're going to take, I'm just going to make up a number, $100 million in tax receipts and take that line item to zero. Where's the $100 million come from? Because that's got to come from somewhere.
Believe me, I mean, according to the Florida governor, Ron DeSantis, he says it's coming from tourism. So they're going to hike the tourism taxes. And, Florida will still be a super desirable place for tourists because all of those European tourists go there, and Florida's a way better deal than any place in Europe, pretty much. Okay. And I've been all over Europe. Okay. I mean, talk about taxes, just go to Europe. If you want taxes, they're everywhere. So I don't honestly know how they do it. I think the biggest question mark would be Texas, because Texas has no state income tax. Neither does Tennessee or Florida. But Florida has the tourism revenue. For Texas, I really don't, because their property taxes are very high as a percentage.
Oh, they're very high, comparatively.
And so I don't know where they would get that revenue from, but I do know that if it happens, it's going to be massive upward pressure on real estate prices. Do not doubt that for a minute.
Could this go the way of I mean, just to take another example, weed, right? I forget what the first state was. Was it Colorado?
It was Colorado and then Washington, I think. Yeah.
Yeah. So again, the first state that did it won. They saw a huge boom, and then you saw other states kind of trickle in, and now it's less effective. I think it's just like that. The first state to dump property tax sees a huge and immediate boom in real estate.
Yeah.
And, others quickly copycat or follow.
Yeah, no question about it. So I did a little math while we were talking on a $400,000 house, like an entry-level house, which I can't believe that's entry-level nowadays. But, your property tax at 1.5% is $6 grand a year. Okay. And, a lot of places are way more than 1.5%. But if it's $6 grand a year, that's $500 a month. Okay.
Oh, wow. Yeah.
So think about how much more mortgage they could qualify for, right?
That's got to be $100 grand.
Yeah,
I mean, it's 6%. Yeah,
it's
got to be
probably
80 to 100 grand. Yeah, that's wild.
So I mean, that may push prices up way more than 10 or 15%. These property tax eliminations,
and it'll be quick.
And then another thing, I don't know how mathematically you would pull it off, but Trump wants to eliminate the IRS, and he nationally wants to eliminate property taxes on a national level. Okay.
Oh, yeah.
The one thing I can tell you for sure is foreign money, FDI, foreign direct investment, will flood the United States. I mean,
money goes where it's treated the best.
Foreign buyers will love that deal,
Yeah. It's going to get really interesting. So I guess as we wrap this up, what are your thoughts on 2026 real estate? Do you think 2026 we get more transactions, price rise? Do we get the crash that everybody says has been coming for a decade? What's Jason's thoughts on 2026 as we wrap this up?
If rates come down and we get in the 5.5 area, and if a couple of those states do eliminate property tax, I think it is going to be incredible. I mean, I think people are going to be jumping into the market like crazy. There's a lot of pent-up demand. A lot of people have been putting off this decision for 3 years now. It's going to be phenomenal. It's not going to be nuts like the COVID era where we had the lowest interest rates in 5,000 years, literally. Okay. Read a great book by David Graeber, the late David Graeber, Debt: The First 5,000 Years. It's a fantastic book. But yeah, I think prices are going to inch up for sure, and a lot of this housing inventory in sort of the worst markets in the country, like Punta Gorda, Florida, Austin, Texas, those markets are going to start turning around pretty well.
Yeah, I love it. And Jason, you're coming out to Vegas, right? You're our keynote speaker on day one Saturday. We are looking forward to having you.
I'm looking forward to it too. That's what are we, February?
Yeah, February 14th and 15th in Vegas.
Oh, Valentine's Day. Awesome.
Yeah,
Good.
Yep. Bring a loved one with you. Jason, you're amazing. Thank you for coming on the show each and every week. Take care.
All right, Michael, you are amazing too. And thank you for telling the truth and letting people know the way it is out there, and, just defeating all those doomers and gloomers, because they're wrong almost all the time. So,
well, I go even a step further. I call doomers evil now. I'm done playing nice. Doomers steal hope, and they're evil human beings.
Yeah.
Later.
Yep. Sounds good. Happy investing.